On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. Let's talk about last week, key releases, key moves, key developments, and then let's turn our attention to what we need to keep an eye on in the week ahead. Global share markets had a pretty solid week last week. The S&P 500 in the US was up 0.2%. Europe was strong. European shares up 1.4%. Japan up 1%. The UK up 0.6%. Australia up 0.8%. So all of those markets pretty solid last week. Emerging market shares were flat, down marginally, but so marginally you may as well say flat. And here in New Zealand, the NZX 50 did slip back a little bit. We were down 0.7% last week. However, that's August done and dusted. We're into September now, and New Zealand did manage to eke out another small gain in August. So the index was up ever so slightly, second month in a row of gains. So that's the first time we've seen two positive months, one after the other, since last year. So that's not too bad. And if things continue, or if at least we hold on to these gains through the month of September, we are on track for the strongest quarter since the final 3 months of 2020. So it hasn't been too bad a period. Most global markets finished August a little bit higher, not all, but most, and all global markets, with the exception of Japan, are up this quarter so far. But we've got a month to go, so probably a bit early to be talking about quarterly returns. However, so far so good. Right, interest rates. After falling sharply in the wake of that OCR cut in August, local interest rates did continue to rise last week. They were up slightly the week before as well, so they have been drifting higher. The 5-year swap rate was up 9 basis points last week, so it finished the week at 3.75. Still well down to where it was at the beginning of July. It was at about 4.5% back then, so we're well below those levels. However, it has continued to push up a little bit. Same story with the Kiwi dollar. The New Zealand dollar continued to rise last week and it was up against all major trading partners. Against the US dollar, it's up 6.3% over the past 5 weeks. So it was down at just below 59 cents against the greenback, I think, about 5 weeks ago. Now it's sitting comfortably above 62 cents, not too far off 63 actually. And it's not far off that 25-year average, which is about 66 cents against the US dollar. Reasons why that's happened: the Kiwi dollar does tend to follow prices for our key export commodities such as dairy, and we all know dairy has been pretty solid. It's been performing well lately. That's why Fonterra recently upped its payout forecast for this season. We also saw a strong rebound in business confidence last week. We'll talk about that shortly. That maybe did help sentiment towards New Zealand. And also, it hasn't been just about us, because over in the US, we've seen growing expectations that the Federal Reserve will indeed cut interest rates this month in September, and that has maybe seen the US dollar just come off a little bit. So the Kiwi dollar's been rising because that New Zealand story has looked a little bit better at the margin of late. Still got some challenges, but there's been some positive news, and because we've seen the US dollar just weaken ever so slightly too. Right, let's run through some of the key releases from last week. And the big one was business confidence here in New Zealand. And we saw a very strong rebound. The ANZ Business Outlook survey for August saw sentiment rise strongly. So businesses and firms obviously encouraged by a couple of decreases in mortgage interest rates and the first interest rate cut in terms of the OCR for this cycle. Headline confidence surged from 27.1 in July to 50.6 in August. That's a massive move, and that actually sees it at the highest level since May 2014, 10 years ago. That doesn't necessarily mean that conditions are the best they've been in 10 years. Remember, this is just confidence, and it probably reflects more of a rate of change in terms of confidence compared to the previous month. So that is the way I would think about it. You still have got a lot of challenges out there, as we all know. The own activity measure, which does tend to be a much more useful leading indicator for where economic activity is going, that was up strongly too. That rose from 16.3 to 37.1. So it's at the highest level in 7 years since August 2017. That's very good as well. And on the inflation front, more reasonable news. I'm reluctant to say good because we actually did see the proportion of firms expecting to raise prices over the next few months. We saw that actually rise slightly. So you've still got some lingering inflation pressures out there. However, when you look at that in terms of the 3-month average, it's at the lowest level we've seen since the beginning of 2021. Not completely out of the woods though, which is really important. Profit expectations moved back into positive territory for the first time in 6 months. That rose to the highest level since 2017, and it was led by retail, manufacturing, and services. So again, that might just be because some of those sectors are some of the ones that have felt really challenged of late. So it might be because they fell so much that we've seen a really big snapback. But great to see businesses feeling a little bit more encouraged about the future. That was the key release here in New Zealand we saw last week. Internationally, it was the US PCE inflation index, which was out overnight on Friday, so we didn't get it till Saturday morning here in New Zealand. PCE stands for Personal Consumption Expenditures, and this is the Federal Reserve's preferred inflation measure, which is why it's really important, because it's what the Fed really is watching when it's thinking about setting interest rates and monetary policy. And this came in pretty much in line with expectations. We saw headline PCE increase 0.2% in the month of July. We saw the core PCE increase also 0.2% in July. And in terms of the annual rates of inflation, at the headline level, PCE inflation tracking at 2.5%. That's the same as a month ago. Core PCE inflation also unchanged at 2.6% from last month. So these are the lowest we've seen in more than 3 years. They're in line with market expectations, and they really do firm up that belief that the Federal Reserve is about to cut interest rates. They meet in just over 2 weeks' time. I think it's the 17th, 18th of September, so it'll be not this Thursday, but 2 Thursdays from now. Usually comes out at sort of 6 or 7 in the morning NZ time. We should get the first rate cut of this cycle from the Federal Reserve. They are at 5.5%. They will come down to 5.25%, I suspect. Some people out there still talking about a 50 basis point cut. I can't see it. I think 25 is the way to go, and I think that's what you'll see in 2 weeks' time. And that will be a really important development for global markets, a really important turning point, with the Federal Reserve, the world's biggest central bank, looking after the world's biggest economy, embarking on that easing cycle finally. So those were the key releases that we saw last week. Obviously, lots of company results too. NVIDIA, lots of company results here in New Zealand, lots of results across the Tasman. Can't go through all of those, but it was a bit of a mixed bag, as it always is. If you want any information on any of the companies that have reported results of late, talk to your advisor. We will have reports on all of them that you can look at in much more detail than I am capable of telling you about. We've got a team of very good analysts that look after New Zealand shares, Aussie shares, international shares, and they are the experts. They do all of the deep dive analysis about all those different companies. So they're the people to ask, not me. But turning to the week ahead, it will be a holiday shortened week in the US at least. Markets will be closed on Monday for the Labor Day holiday. So a 4-day week in the US. It won't be until Tuesday US time, which will be Wednesday morning our time, that we'll see any action stateside, but there will still be plenty to monitor, particularly on the economic front. We've got the latest ISM indices for both manufacturing and services, and we've got the monthly jobs report in the US. So these are some of the biggest economic releases that we see globally and in the US. So the ISM manufacturing index is out on Tuesday. ISM stands for Institute of Supply Management. The manufacturing index out Tuesday. Its services counterpart will follow on Thursday. That's US time, obviously. The manufacturing index has been pretty weak. Of late, it fell to 46.8 in July, which spooked markets a little bit. That was well below forecast. It was the lowest in 18 months. And while a contractionary reading below 50 is nothing new, after all, the ISM has been below 50 for 20 out of the past 21 months. There's only been 1 month over that period where we've seen a positive or an above 50 read. But last month, the details were quite soft as well. We saw the employment index slump to the lowest since June 2020, and a few other bits and pieces that just suggested that the manufacturing sector was in worse shape than we thought. Pleasingly, the services PMI for July for last month came in stronger than expected. So it moved back into positive territory where it's been for the best part of 18 months, 2 years. So services has still been strong, but markets will be watching these two surveys on Tuesday and Thursday, I should say. Then we will get the jobs report, which will probably be the key release of the week. The labour market is really, really important for the path of the economy, for inflation, for monetary policy, and for corporate earnings, because remember that the US consumer represents, about 2/3 of the US economy. So it is the most dominant thing in the world, really, the US consumer. And the health of the US consumer is strongly linked to job security and the health of the US labour market, and whether people feel comfortable spending, borrowing, whether they feel that their job is safe. So the labour market is at the centre of everything, really, over the next little while. It will be the defining feature in whether there is a recession or a soft landing, and whether we see inflation continue on the path that we're hoping it will, which will allow the Federal Reserve to ease monetary policy over the next year or two. But anyway, the August non-farm payrolls report out on Friday. We'll see it here in New Zealand on Saturday. This will be the last one, obviously, before that big Fed meeting in just over a fortnight. Last month's jobs report was really interesting because it came in weaker than expected. The unemployment rate increased from 4.1 to 4.3. People didn't expect that. They didn't see it coming. They thought it would go sideways, and it went up, hit the highest level since October 2021. And you got a lot of recession talk because it triggered something called the SARM rule, which I won't go into detail about right here and now, but it's one of those indicators that people watch that does tend to be, historically at least, quite useful when it comes to predicting recession. So recession talk heated up after that soft unemployment report, and this month unemployment will be in focus again. Markets expecting 165,000 new jobs to have been created, and interestingly, they actually see the unemployment rate falling back slightly. They see it coming down ever so slightly. So last month it went up from 4.1 to 4.3. Markets now see it coming back to 4.2, which would be good news. I think markets would be comforted by that. You want the labour market to hold together and be solid. You don't want it to be super strong. We don't want to see unemployment falling down into the low threes again, because that will mean that wage growth goes through the roof, which again isn't a bad thing. But what it does mean is that inflation will be really high, and you'll see interest rates stay high or even go higher. So it's kind of a balancing act, and you want it to be, in that Goldilocks zone, not too hot, not too cold. But that will be the key release in the US on Friday or Saturday morning in terms of the New Zealand timing. Here in New Zealand, it's a bit of a quieter week. The only thing really to keep an eye out for is dairy prices. We'll get the results of the latest dairy auction out early on Wednesday morning, so the agricultural sector will be hoping for more of the same, because the last auction 2 weeks ago was very strong. We saw the GDT index rise 5.5%. That's the third increase in a row, and it was the biggest we'd seen since March 2021. We also saw solid gains for most products across the board, and whole milk powder was particularly strong. It was up 7.2%. So farmers will be hoping that we see more of that. Fonterra did upgrade its payout forecast, as I mentioned at the start. So the midpoint is increased from $8 to $8.50. That would make for the second highest payout of all time. The only one that would compare with that was that $9.30 payout that we saw in the 2021-2022 season. However, that doesn't mean that the farming sector is all well and good. There are still lots of farmers that will be doing it tough out there, because remember that $8, $8.50 is not what it used to be, because you've seen costs rise, as they have for all businesses, all consumers, whether it's regulatory costs, whether it's wages, whether it's input costs, whether it's interest costs. All of those sorts of costs that farmers face have meant that $8, $8.50, that would have meant they're rolling in it 5 years ago, 7 years ago, but today costs have gone up too. So it means that the margins are still somewhat subdued. So that's just something to bear in mind. That's really it, to be honest. There are a few other bits and pieces to watch. We will have retail sales in Europe. We've got some good news on the inflation front in Europe last week, down to 2.2% annual inflation. That's down from 2.6%. So that's firmed up hopes and expectations of more interest rate cuts from the ECB in Europe. But retail sales and economic growth, a GDP update in Europe. In China, we'll get a couple of PMIs, which are activity indices. PMI stands for Purchasing Managers Index. Those are sort of similar to those ISM indices that we'll see in the US. So we'll get a manufacturing one in China on Monday afternoon, a services one on Wednesday afternoon. Across the Tasman, quite a busy week across the Tasman, actually. House prices, second quarter GDP, speech from Michelle Bullock, the RBA governor. She's speaking on Thursday, so there's a few bits and pieces to watch across the Tasman. Here in New Zealand, like I said, a pretty quiet week. Just that GDT auction is the key release, and not much at all on the corporate front. There's virtually nothing in New Zealand or Australia. Internationally, also pretty quiet. Dollar Tree and Fastenal, the only two companies that are on my radar in terms of results this week. So it will be a little bit quieter before we head into the rest of September and see a few of those key events, such as the Fed meeting. That really will be the highlight. And then when you're into October, we'll do it all again with the US and international reporting season. They come around so quickly, don't they? But for now, we'll leave it there. Thanks, team. Thanks for listening, and we'll talk again soon.
For more insights, visit craigsip.com.